In the last episode, we were talking about how can board act in order to see that disruption on a very early stage, and how to avoid to see it when it becomes a strategic issue. And I would like now in this episode to go a little bit deeper on oversight versus ownership, and even go to say that ownership is necessary in order to pick up early signals of disruption. So in this type of companies, the disruption is not about replacing a product. The disruption comes through adding adjacent technologies, like, for instance, digital layers or connectivity, or more a system approach, a service approach versus buying and selling products. So the products still remain, but its role, its application, also its margin structure is changing. And also, very important, what is changing is the differentiation of the product. The question is, do board hesitate to pick up those technological discussions at board level? And I would say yes, but that's not really a problem. In technological companies, the discussion of technology, of course, is more the domain of engineers, and it's very much in the operations. And boards should not engage in those deep details about, architecture changes or new technologies. But what board should definitively engage in is the discussion about the strategic implications of those changes. And how you do that, how you can discuss those topics, those strategic implications. Well, it's first what I also mentioned, I think, several times before. It's about understanding the business model and how the business model is evolving. That's very important. Then it's the domain of the board, the capital allocation. And I will come back to this a little bit later, because I believe that this is a central point. Of course, the risk exposure, it's also a typical board topic. And both capital allocation and risk exposures are the consequence of the strategic priorities. So the debate is not about, how technology is built, but it must insist in being very clear about the strategic problem the technology is supposed to solve at the customer. Then how this might change, or is changing, is supposed to change the customer value, how it affects the cost, how it affects the pricing, and very important, how it affects the differentiation of your products. Well, what I mean with ownership, because I mentioned before that you might even want to go from oversight to ownership in this type of industrial technological companies. What I mean by that is taking the responsibility for whether the company is structurally prepared for that technological driven change. For me, this includes several things. To make sure that the transformation topic exists on the agenda, that you have that transformation agenda. But also very important that you protect the long-term investment versus short-term pressure. And you prevent by this the organizational inertia. So it's not about interfering in the R&D roadmaps. It's about securing that you have the means and you understand the strategic implications. Well, I think it's obvious. It's more the discussion about how you structure that, because the way I have seen that the technological discussion is coming into the boardroom is through, for instance, engineering topics, or through, these are future options, so roadmaps, future options, or even through pilots. These are the pilots we want to run. But for me, the most important question which we should put an answer and spend time on is, are all these initiatives central or peripheric for the future competitiveness of the company? Because if they are centric, then it has strategic implication, and then we should spend more time on that. If it's peripheric, then maybe it's not worth spending a lot of time. But that distinction, I think, it's very important. So yes, in my view, strategy comes first and technology comes second, because specific in this type of industrial technology companies, the technology investment is expensive. So it's expensive and it's very difficult to reverse, which means that once you have taken the decision on the strategic orientation, it's very difficult to come back. It's not like making another update of a software. This is deeply embedded in the product generation. It's deeply embedded in the operation. So yes, in my opinion, the strategic intent comes before the technologic or the technical execution. Absolutely central point for that is the capital allocation, and that is typically a board decision, especially as capital allocation, for instance, for new technology, is in direct competition with what investment I'm doing in the core business, which still is very profitable. How much money I'm putting in the efficiency programs, and also what dividend expectations do I put as a company. So these technology-driven initiatives also very often are depressing the margin at the start before they create value. So without an explicit board support for those investments, the management will naturally prioritize short-term and profitability initiatives. So typical signs for me where you could, raise questions are if you see that these technological initiatives constantly are postponed, are rephased. You have a lot of pilots which are never scaling, or you see that the innovation budgets are treated discretionary. For me, it's, as I said before, important that boards ensure that the transformation funding is protected and it's not something which happens opportunistic. Disruptions, technological disruption, and I think any kind of disruption is, of course, introducing uncertainty in the organization. When it comes to technology, we are talking also about a lot of learning. We are talking also a lot about iterations. So this is creating a lot of tension internally in the company. So you need to make sure that you are not underestimating how for instance, the incentive system is aligned with your strategic intent, but also how the power structure is shifting or reshaping. And these are problems which appears and the board needs to be aware of. And how to be aware of, I think the questions which needs to be addressed are we rewarding the future success, or are we rewarding the current excellence? No? And how do we reward that? Do we have the top talents, which we need in the next year to come? And also, how leaders are truly empowered to drive that transformation. For me, the incentive system, which is also a discussion at the board level, it's very important to make sure that it's serving the strategic intent of the transformation. Well, a closing reflection. When it comes to technological companies, industrial companies, where capital allocation is important because it's massive and the transformation are slower, I think it's important that the board is the guardian of the strategic coherence over a longer time. So sometimes board needs to accept a temporary inefficiency in order to protect a future relevance. Transformation often fails because it has not have that coherent support over a longer period of time.